To generate exactly $5,000 a month in dividend income without ever selling a single share, you have a choice to make. There are two specific portfolios that both produce exactly that amount. The first one costs $323,000. The second one requires $2,857,000. Both of these portfolios trade in the same market during the exact same month and generate the exact same income, yet one requires nearly 9 times the capital to acquire. Finding a realistic way to live off dividends without destroying your savings requires figuring out why this massive price gap exists and identifying the hidden third structure that sits directly between them. Consider an investor named Jake. He wanted that $5,000 paycheck quickly, so he sorted a screener list of income investments by yield and picked the top result. It advertised an 18% return, placing his total price tag at that cheap $323,000 mark. This reveals the mathematical flaw in Jake's strategy. Dividend yield is a fraction. Annual dividend cash sits on top, share price sits underneath. Yields can skyrocket for the wrong reason. When the share price collapses, the resulting percentage artificially inflates. Jake got exactly what he paid for. His $5,000 checks arrived every month, but the account funding them was steadily evaporating underneath him. For every dollar the company paid out, $1.28 of his book value disappeared. A massive yield is most attractive precisely when the underlying business is at its weakest. The highest numbers on any ranked list are populated by companies systematically liquidating themselves to keep up appearances. If the ranked list is hiding the truth, we need a different metric to figure out where the money actually comes from. Every fund publishes an official fact sheet containing 2 specific numbers that most investors never put side by side. The first is the 12-month trailing distribution. That is the actual cash the fund handed out to shareholders over the past year. The second is the 30-day SEC yield. That is a standardized figure measuring the income the fund's holdings actually earned. This chart compares those two metrics for one of the oldest covered call funds in the United States. The massive bar on the left represents the fund paying out nearly 11%. The microscopic bar on the right shows his actual earned income was about half of 1%. Roughly 95% of the cash handed out was not traditional earned income. That missing 95% isn't a scam, but it demands an explanation. We have to identify exactly what mechanism generates this extra cash and figure out what you are giving up to receive it. That mechanism is a covered call. The fund owns a basket of shares, and it collects a cash premium by selling someone else the right to buy those shares at a fixed target, called a strike price. That cash premium becomes your monthly distribution. This graph illustrates what happens when a fund sets that strike price exactly at the current share price, a strategy called at the money. You harvest a large cash premium, but the moment the market rises, you hit a hard ceiling. The upward momentum belongs to the buyer. Because you surrender the growth, you have nothing to offset drops. Over a decade, your capital drains away to fund your paycheck. There is a newer strategy that avoids this entirely. Some funds sell calls out of the money. They set the strike price higher than the current share price. By setting the target higher, the fund collects a slightly smaller cash premium, but it keeps the upward market growth right up to that new ceiling. That retained growth is enough to offset the erosion, detaching your monthly income from the destruction of your account. This out-of-the-money strategy is the third door. An investor named Marcus chose this route. To get his $5,000 a month, he needed between $510,000 and $738,000, depending on the specific fund he used. To see why this matters, we have to translate those dollar amounts into time. Assuming a standard contribution of $2,000 a month, the actual price of these portfolios is measured in years. Jake hit his cheap target in just 9.8 years, but he bought an asset that is quietly liquidating itself. Then there is Sam, who chose the hyper-conservative dividend aristocrats. To reach his enormous $2.85 million target, he will be saving for 33.5 years. Marcus and his third door land directly in the middle. His out-of-the-money strategy requires between 13 and 17 years. He pays a few extra years compared to Jake, but he saves roughly 2 full decades compared to Sam. Passive income always demands a price. You either pay with your underlying capital, or you pay with a massive fraction of your adult life. The third door is the fastest honest route available. Because when you finally reach the finish line, you actually get to keep the machine that pays you.